The U.S. dollar is extending gains for a third day on the back of today's economic data. However, many seen that the currency as a proxy for the Trump trade, with tariffs seen as a bullish signal for the greenback. Joining us now, we want to bring in Steve Dooley. He's head of market insights at Convera. And Steve, it's great to have you here. So let's talk about where the dollar is headed, because the strength obviously is something that many investors, many traders have been closely tracking here over the last several weeks. How much is riding on the election outcome when we're trying to gauge what that future move is going to be?
Yeah, look, in terms of Q4, the election's going to be the most impactful event for the US dollar. We've seen that over the last 3 months as we saw post-Joe Biden's resignation from the race. We saw the US dollar fall as the likelihood of a Trump presidency, according to polls, according to the betting markets, fell. And that really continued that theme up until the start of October. We saw the polls start to tighten. We saw betting probabilities improve in favour of Trump, and we saw the US dollar snap back really significantly, up more than 3% in October. So financial markets are telling us, in terms of FX markets, that a Trump win, the potential for tariffs, the potential for inflationary impact, and also the impact on those real trade-sensitive currencies like the Canadian dollar, like the Chinese yuan, is all building into the fact that for the moment, markets see a Trump win as more positive for the US dollar.
And see, something that stuck out to me in your notes that you sent over was that the first reaction usually doesn't stick when it comes to the FX market, and ultimately what that means for the election. So how are you advising, or what is your advice then to investors? Is this a trade that maybe they should be staying on the sidelines for a couple of days? Is it a couple of hours? I guess, how should they then be thinking about the timing?
Oh no! So when we say the first reaction sometimes doesn't stick. It can be a couple of months reaction until eventually that long-term move starts to play out. So historically, over the last 50 years or so, there's been a really clear, tight relationship between a change in the presidency and a change in the overall trend of the US dollar. And historically, it's been the fact that Democrat presidents have tended to be more supportive of the US dollar, and Republican presidents have tended to see the US dollar weaken. And that said, if we go back historically over the last couple of elections, 2016, the initial reaction was again that a Trump win would be positive for the US dollar. We saw that the greenback really gained for the first couple of months after the election. But throughout most of the Trump term, the US dollar was weaker, and that played out with that historical bias that tends to see Republican presidencies see the US dollar weaker. Again, after Biden's win in 2020, the US dollar was initially weaker. Again, that was the story about perhaps we'll see tariffs relaxed. That helped the Australian dollar, the Canadian dollar, the Chinese yuan to outperform, and the US dollar start to weaken. But with Biden's large spending programs, that move that ended up seeing inflation higher and interest rates higher, that saw the US dollar really outperform. It's up about 14% over the Biden presidency, and that's the third best presidential performance since 1970. So when we say the first reaction doesn't stick, it can be a couple of months. So traders will be looking to really take advantage in the short term of that current phase where a Trump win positive for the US dollar, a Harris win more positive for those trade-exposed currencies, and the US dollar likely to weaken.
All right, Steve Dooley, we have to leave it there. Thanks so much for taking the time to join us here this morning.
Thanks for having me on.